Hi, good evening, everybody. And a big thank you for staying in the room, because obviously you had a choice. This is the last session to do networking outside, but you have chosen to be inside, so thank you very much. We also sit between you and your drinks, so hopefully we'll be dot on time and finish on time as well. So the topic we have today is going to talk about the hidden risks in trade. So while we will talk about the risks that are associated with trade, but I also want to pivot this conversation more towards how, if these risks are managed, it helps us grow the trade finance business. Before we get into the session, I would like to do one round of introduction with my panel members. We've got a very diverse panel today, but starting with myself, my name is Anirudh Panse. I look after the trade finance business for FAB globally. So maybe you can go in this order.
Yeah,
Yogesh?
thanks, Ani. Good evening, everyone. I'm Yogesh Patwari. I've worked with this company called Credible. We're a technology player, both enterprise and banking SaaS. Before Credible, I've spent my career in banking, working with multinational banks in trade finance and corporate banking.
Hi, good evening, everyone. My name is Ibrahim Al Aswad. I work for Barclays Trade Finance, Trade and Working Capital Origination Team. I have 20 years of experience in the trade finance field. I started in Jordan, then moved to the UAE back in 2011. So 14 years in the UAE.
Hi, Sri. Good evening, everyone. So I work for Standard Chartered Bank, covering group transaction banking compliance. I am in the UAE for past 20 years, having both first line and second line experience in trade, as well as in the compliance side.
Thank you, gentlemen. So as I said, we've got a good diverse panel. We've got a large global bank. We've got a large regional bank. We've got somebody who represents the technology side of things. We've got somebody from compliance, somebody from the business. So it's a good panel. Before we get into the questions, I just wanted to set the stage in terms of what's happening globally. So if you look at last year, the global trade business or the flow of goods that happened was roughly about $35 trillion globally, which was almost 7% above 2024. If you look at the GDP growth projected for the next year, it's depending upon which institution you look at, it's somewhere between 2.8 to 3.2%. So again, next year is, or this year is expected to be a very strong year for trade. Closer to the region, or closer to our home, the region is expected to grow almost 5% in the UAE, similar percentages for the region as well. There is a lot of diversification of the trade business that is happening away from the hydrocarbons industry, which means new sectors will come in, new geographies will open up, and of course what's happening globally around the wars, the tariffs, is all changing the way the trade business is happening. So if you put all of these things in perspective, we are in the trade business and we are in the middle of a change. So that puts us even more pivotal to be managing the risks, right? So I want to start with you, Shri. Given all of this that is happening, can you summarize what the problem statement is? What does trade TBML mean, and why is it important?
Okay, so TBML, I'm not going to give you any different definitions of TBML. So TBML is basically trade-based money laundering, which involves like disguising the illicit or proceeds of crime through trade transactions in attempt to legitimize those proceeds of crime into it. So that's the basic thing, what we are going to look at. It's very similar to any other money laundering activity, but using trade transactions. Why it is important? That's a good question, right? Why suddenly there is a focus on trade? So overall, we have grown up to ensure that we detect money laundering through your normal payment system. So now criminals have found a way, or rather easy way, to ensure that to do all those things through trade. And why? One, trade is voluminous. That's number one. Number two is easy to disguise because of complexity in terms of documentation involved. Falsification of documents and all those things would obviously ensure that they try to inflict all these things to ensure they do this money laundering. So basic typologies of trade-based money laundering would obviously everyone be aware of: under-invoicing, over-invoicing, under-shipment, over-shipment, and duplicate invoice financing as well. So for example, I give an invoice to a bank. The same invoice goes to another bank in terms of open account trading, so there is no checks available really to ensure that the same invoice is being financed in two different banks I would even give an example of the same invoice given in same bank under two different products as well. So what kind of controls we have, let's talk about that later, but these are the things which are happening today alongside your phantom shipment and all those typologies which are there in trade-based money laundering. So to conclude in terms of what exactly is happening today is that more and more trade is on the focus. We will talk about open accounts separately later in the session. How does it impact overall TBML? But yeah, so to ensure we detect all these things, there should be a proper collaboration between financial institution, regulatory bodies, private institution, international organizations to ensure that we all monitor, not just one. More focus is on like financial institutions. So that's how I would see that TBML and what is the importance of TBML over here.
Sure. So I think you raised a very important point, right, which is the nature of the trade has changed, right? So earlier, if you look at even this region where we sit in, this region was predominantly looking at trade meaning letters of credit, trade meaning letters of guarantees, trade meaning trust receipts, right? But that has changed over the last 5, 6, 7 years. I would say a lot of business is happening through open account, which means that the corporates are doing businesses with them directly, lesser intervention from the banks on the trade side, but which means that volume has shifted either to more sophisticated products like supply chain finance or receivable finance, or they have gone more towards the payment side of the business, right, where the settlements are happening. So do you see, and maybe this is a follow-up question, Shri, to you, and then Ibrahim, I'll request you also to kind of develop your thoughts on it. But do you think the nature of risks have changed because of this change in behavior from our corporates and the way trade business is done now?
I would say yes, definitely, because as the region shifts towards open account, right, so there is always an opportunity for the money launderers to ensure that they do it easily. Why? Because probably fewer documentation or no documentation.
Yeah.
So detecting is completely away from the radar. So in a documentary trade, you would obviously go through all the documentation when you process the transaction to see in terms of even flipping the bills of lading to see whether it is a Xerox, color Xerox copy or a original bill of lading. But over here, it's completely away. So definitely there is a shift, and I would say that because of which there are so many things which happens that like misrepresentation of the overall trade, even the structure, underlying business of the client, and overall the institution is clueless in terms of what is happening. That's number one, right? So is there a way to do it? Probably all the disguising happens because of the voluminous and the complexity which are involved in the overall open account space as well. The next thing is like, you don't have, because of the volume is high, you don't have people to sit and investigate or look into each and every transaction, right? So you're in search of probably Yogesh. He will talk about it later, but so that's something which we are struggling with in terms of technology because of volume increase, because of less visibility in terms of what is happening in the underlying trade transaction. So that's going to be very difficult because of the shift moving from documentary trade to the open account trade.
Okay. Ibrahim, do you agree with this? Do you have a different?
I would take this practically as well. We still see LCs. We still, not only LCs, the documentary credit, and from the name, the documentary credit means you look more at the documents. Banks tend to check the documents, and then mismatching, under-invoicing, and over-invoicing will jump off the documents. While in open account trade, you're doing selective receives financing, or we call it selective receives financing. I mean here, receives financing or supply chain finance. While maybe after the trade happened, the payment moves faster, the trade moves faster, and the transaction would come to you after that. Three things we need to look at here. Does the trade make sense?
Yeah.
And for example, a supplier is routing the documents or routing the shipment from country A to country B, then country C, which adds cost and add cost and add time to the transaction. As bankers, we look at this and see if this makes sense. We send our inquiries normally to the clients, and if the justification comes back in a way that we don't like, then this is something of a concern. Second point here, are the parties make sense for us? A small supplier, for example, supplying big amounts under a supply chain finance program to a large buyer. the buyer have done their due diligence. It's a bidding process, and the supplier won this transaction. So, are they capable of this small amount, giving 180 days? So that thing is not making sense for the bank. So these are things to spot. Then, and when we come to Yogesh, the pattern, the behavior, we have the same supplier, same payments, same trade on monthly basis. Do we have enough data analytics, or do we have enough systems or tools to cover us and make us find these changing pattern and changing behavior?
That makes sense. And I think if you look at all of this in the perspective of the shift in the region with lesser documentary credit, so if you look at even the overall SWIFT volumes, which process the documentary credit, whether you look at the volume or you look at the values, you will see a significant decline that is happening in the volume and the values, which means as banks, as organizations, we need to be better prepared for addressing these risks. And as Sri, you rightly mentioned, in an open account, you get lesser information, and therefore the onus is on the banks, therefore, to find that right trade or the wrong trade within the right trades to make sure that you catch it. But again, so Yogesh, I think we are all part of the problem here. I think you are the only part of the solution.
Probably just one point before we move to Yogesh. So just wanted to stress this point. There is too much of focus on documentary trade, number one. Number two, there is a too much focus on financial institution. I would request overall the global regulators or the industries to also focus on private and public entities like your shipping companies, your freight forwarders, your customs and whatnot, in terms of them quantifying the movement of goods and what kind of documentation they see when it comes to them. That's more critical, equally critical, and there is a wrong perception towards that, too much focus on documentary trade. So we tend to lose monitoring or having some kind of eye on the open account side of it. Unless we partner with them, unless the focus shifts from financial institution to these kind of players or PPP.
Yeah.
We talk about that every time, but I don't know how effective those are. I don't see that happening in the industry. So all things definitely should focus on that, and definitely we need to ensure that all those things are tied up to ensure we fix this issue as well.
Okay. So Yogesh, the floor is yours. So from a technology perspective, obviously you heard our problems. You've heard, I'm sure when you talk to banks, you hear about what the challenges are. And one of the biggest challenge also is how do you get so many ecosystem players who touch the physical trade, right? To be part of a system. Because if you look at it from a technology perspective, I think the technology has always existed. Everybody, if you ask anybody in the room or outside whether you should be solving this problem, I think everybody would say yes. But I think the traction has not picked up. So what's your view from a technology perspective?
I think for those of us who've heard Omar's keynote speech today earlier than day, this may be a repetition because he did cover importance of technology in his speech. But let me try to answer this in my way, and thank you for ganging up against me. Let me do this in two parts. First, I'll talk about how the landscape is evolving, which is actually fueling a lot of this innovation from a technology perspective. And second, what are the actual solutions that players like us are building, which can help detect and prevent TBML. So, for the last 2 decades or so, I think all players in the trade ecosystem, and this includes corporates, this includes banks, this includes shipping companies and other players, including regulators, they have been working on digitalizing the entire process. Now, this helps in multiple ways, and when I talk about the solutions, I'll see how, we'll see how this helps. But essentially, this is, in a way, creating digital data that can be accessed almost on a real-time basis for verification and validation. At the same time, regulators are investing in digital public infrastructure in many countries. And of course, some countries are leading the journey. Some countries are trying to catch up. But here, for example, in the GCC region, we've got Saudi Arabia and UAE focusing on DPI a lot. In Asia, we have countries like Singapore, Philippines, India, who've invested a lot in DPI. We won't expect a country like Brazil to be leading, but then again, that's one country which is ahead of the curve from a DPI perspective. What digital public infrastructure also enables us to do is primarily 2 things. One, validate KYC, and it helps us to do this almost on a concurrent and real-time basis. And second, wherever the infrastructure enables digitalization of trade processes, we can again, verify the authenticity of trade transactions. Now, using all of this, of course, not that we have already reached an ideal stage here from a DPI perspective. A lot of work has been done on the individual KYC perspective, individual KYC side. A lot is desired, as far as cross-border trade is concerned, for example. So a lot of countries have infrastructure available for domestic trade transactions, both for invoice validation and transport document validation. But cross-border is something that is evolving. It's a journey which hopefully will reach there soon. Coming back to the technology solutions that we are developing, again, I think talking about individual solutions would take probably the whole session, but broadly we can put them in 3 categories depending on where in the transaction lifecycle they sit. So we got pre-transaction stage, we got during the transaction processing, and then post-transaction processing. Pre-transaction typically is around risk scoring that helps in better prioritization of monitoring, from a TBML perspective. During transaction processing is where we use the DPI the most. So we do verification and validation of information to make sure that the transactions are genuine, they're not fraudulent, they're not duplicate, and all of these checks come during the transaction processing phase. And post-transaction processing is which is seeing the most development from a technology advancement perspective in recent times, which is around pattern detection and analytics. So which is where, banks using platforms or solutions provided by technology players like us are able to predict behavior of customers and then prioritize which transaction should be, monitored, from a closer lens.
I do want to talk to you about specifically which technologies play a critical role in this, but before I come to you on this, I do want to go back, and as I said at the beginning of the conversation, I don't want this to be only a risk conversation, right? I want to also pivot this conversation a little bit towards growth, because if you're able to manage the TBML risks better, then that also enables the business to grow, right? Business to grow, and if you look at, again, depending upon which report you take, there is anywhere from $2 to $2.5 trillion of the SME working capital gap, as we all know of, which means this is funding which the SMEs are seeking, but simply the banks are not, or the financial institutions are not able to provide that funding. And then the second lens, if you use, which is of the SMEs, and you can talk about the UAE or you can talk about globally, they make almost 70 to 80% of the GDP, right? So they are very systemically important. Now, if you look at third lens in terms of whether banks like the SME business, I think with all the discussions that go, and I'm sure you're part of all the credit committees and the risk committees and the pricing committees where you get hammered on the returns and the revenues. I think that's the business which never gets hammered, right? Because you've got fantastic returns, fantastic revenues, but the risks are considerably higher. So how do you link this whole conversation back, looking at SMEs? Yes, they are present in the UAE and in the region. The business is growing. The pivot is towards non-oil trade, as I talked about. How do you manage the risks, and therefore, in your view, how does this help grow the trade business for the banks?
Very good and relevant question. So we always talk about risk controls, etc. So people would always say that, we need to control the risk. But how does that enable growth? So probably 2 things, right? So here we wanted to split this between corporates and banks. So how does corporate benefit out of addressing the TBML risk, as well as how banks does that and how it enables the business and growth overall? First point I would like to mention, if you were present in the session which happened between I think earlier session, very similar point was mentioned over here where Pinas from Visa mentioned about trust. That's the first thing I would like to put forth here, that from a corporate perspective, be it SME or whoever it is, so that trust is something which is very, very critical. So the moment the corporate ensures that they do right thing, probably their own trust begins. I'll come to the bank, how trust comes into place, but from their perspective, it's robust credit. The controls are there. Corporates need not worry about provisioning of big tickets. Of course, there will be something or the other, but definitely when you put certain controls like clients KYCs, those things would enable them. Probably Yogesh can tell that he spoke about some KYCs. How does that happen within the corporates? Corporates can utilize AI, corporate can utilize emerging technologies to ensure that they have right controls. So that's from a corporate perspective. So you get more confidence in terms of your own status, and then with confidence you go to the banks. On the bank side, the more and more you have controls, couple of items where you get some kind of reputation with the regulators. That gives you more confidence in terms of the industry where you are. That's number one. Number two, probably because of which corporates also trust you, saying that, hey, they have better controls. So they come with that open mind that, okay, when we go to them, our transaction wouldn't end up in any kind of lesser due diligence in terms of transactions or underlying transactions would go at any kind of loss situation. So those things would bring back that confidence, and that is how you need to drive, and it automatically drives that confidence so that growth improves over there.
So managing that risk is very important, not only from protecting the balance sheet and the shareholders, it actually also fuels your growth and your business targets, right? That's the point I mean. Okay, Ibrahim, what about you?
I would agree with Sri on the KYC aspect of this, banking the right client, the large. For example, again, I'll go with one example, is an open account with supply chain finance. You go to the right set of clients, the buyers, and understanding their due diligence, what they do to identify their clients, identify not only the risk of credit here, we're talking about the risk of money laundering. So dealing with the right buyers, okay, will gain you more trust on, and it will help you at the same time understanding their credit process, understanding how they identify the buyers, how do they provide with credit terms from their suppliers, from their buyers. So you understand the clients that you're working with, which will gain trust internally, even with the stakeholders. This is the first point. The second point on your product, on the product program, while you're developing the product, I think you would put risk mitigants, credit risk mitigants, and at the same time, compliance risk mitigants. And most of the times they're matching. And sometimes you refer to the compliance risk mitigants that you're putting to provide comfort to the decision makers here.
Yeah, a couple other points, right? So this was discussed a decade ago. I'm just going to put this point, and regulators very often say this as well. De-risking is not the solution. You need to set the right controls to ensure you do the business in the right environment and you do it right. So just want to insist, not only for financial institutions, even for the corporates, especially for SMEs. That's where the financial institution lacks confidence in terms of what is the corporate compliance over their businesses. So again, so de-risking is not the solution. We need to think about controls in place. How do you operate in a riskier environment with properly right set of controls in place?
And I think the responsibility is therefore, if I'm rephrasing what you're saying, but correct me if I'm not, what you're saying is that the onus is also on that SME to then therefore make themselves more data, more information, and be more transparent, which gives them the confidence to the banks so that the banks can lend more money to them.
Perfect, yeah.
Okay, so
just one point
yeah,
here, Ani. I think both of you mentioned this. You'll be surprised, but a lot of large corporates are already working on extensive due diligence of the counterparties that they work with. And we have been in conversations with a lot of global multinational companies for deploying some of our solutions which can do this validation and KYC check for them. Now, this is probably stemming from what you mentioned, right, where banks are also looking at corporates for comfort, for analyzing the counterparty risk.
Something which I want to mention, I don't remember the exact terminology, but the financing what you does goes till the end supplier so that it helps those SMEs as well to ensure they get the right funding at a proper stage and it follows through the actual supplier as well. So there is some terminology around it from a business side, but I don't remember exactly, but that is another way where the underlying 1, 2, 3, 4 levels.
You're talking about the deep tier or multi-tier supply chain finance?
Yeah.
Okay, yeah. I've heard about it. In fact, I think Standard Chartered Bank in Asia, you've gone up to, I've heard this from some of your colleagues, up to 18 or 19 tiers down. And that's, if you look at it, and that's the tier which need the funding the most, not necessarily the tier at the beginning.
And that would bridge the gap of that SME
of the SME funding as well. So, and I think it's a win-win because then banks are not compromising on the risk because the risk still sits on the anchor buyer or some of the better credit-worthy parties in the whole physical supply chain, but you end up giving money to people who actually need it, right? So back to you, Yogesh. So you talked earlier about how technology and the various aspects of the solutions that you mentioned, but little bit, and I think AI again, this panel will be incomplete if we don't talk about AI. So from your perspective, what are some of the AI-based tools that are being developed, have been implemented, used by corporates and banks, which helps them specifically address this point about TBML?
Sure. So I think let me put again the solutions that we have, which use AI into buckets. I think talking about individual solutions may not be relevant, but broadly, what does AI do as far as TBML is concerned, right? First is better prioritization. So, the effort is always to create fewer false positives. So when you are trying to detect risk and, flag transactions which need, more scrutiny perhaps, while making sure that you're able to process large volumes of transactions at speed, it is very important that you're not really flagging out, every transaction that does not, let's say, meet a stated criteria. So we always had technology. Ani, you mentioned at the beginning of the session that we always had technology, and technology has been used by banks to process transactions. And rule-based tools have always been available. But what AI is now enabling is that these rules can be read together with context. So they're not just blindly flagging of transactions based on certain rules that have been set, but they have a deep understanding of the underlying transaction pattern, the counterparties involved, the goods involved, how does trade finance generally work. So this, I would not really call this agentic AI, but yes, this is helping better prioritization from a transaction processing perspective, which is bringing speed and which is again bringing more accuracy in transactions. And second, I just go back to my earlier answer. Analytics and pattern detection is becoming very important. This is where AI is playing a major role. So it can rely not only on market intelligence, but also be the history that may be sitting within the bank itself. I think in one of the earlier panels, somebody did talk about a lot of data being available with banks, which banks have not really put to use. But that data can fuel a lot of intelligence for the AI tool to actually understand which is the transaction that needs a broader scrutiny. But yes, it is not a silver bullet. So AI tools should be used with careful consideration and definitely not used where regulatory interpretation is required. So that is one area which definitely we should try not to use AI in.
Can you expand a little bit more? Because if you look at trade, for example, there are two challenges, right? One, it is paper-based to a large extent, although that has changed post-COVID, yes, in my view. But still, there is a lot of paper involved. And two is the paper is unstructured, right? If you look at, I was talking about 70% SMEs, we'll have probably 90% invoices, right? Different types of invoices. How do you, can technology cater to this unstructured data now?
Yes.
Is it in a better shape now than what it was a few years ago?
Yes, totally. And this is where AI's importance is understated. One, you clearly mentioned that a lot of digitalization has already happened. So a lot of paper documents, so physical papers coming to the bank's branches, that may not be happening anymore. So we've got tools that can validate and verify a lot of this information digitally. That can be done without AI as well. But where AI is important is, for example, let's say you pull a certain, you validated the shipping bill as genuine and it's a genuine transaction. But then there may be a lot of data on the physical copy of the shipping bill, which can help the AI engine to check, okay, the transaction seems to be genuine, maybe a shipment has happened, but is the value overstated or understated? Is the counterparty genuine or not? Is this coming from a country that's high risk or not? So this analysis, AI tools can do basis unstructured documents which are non-standardized. So we've got tools available now which can look at unstructured, non-standard documents and then link it back to the LLM models and again, potentially either feed that back into a recursive loop to sort of create a pattern detection model or flag off the transaction as something that requires a more detailed scrutiny.
And how accurate are then these this AI extracted information? Are there a lot of false positives? You mentioned something about this before. Is it onerous on banks? Is it onerous and can this be extended then to corporates as well as a natural extension? Because at the end of the day, the corporates generate the documents, right? We are processing those documents.
So it's a journey, but I think we're already at a stage where these can be implemented with banks. without thinking of unintended consequences. So it's not. I think the technology is now fairly advanced to make sure that we're not in a situation that's worse off, from the present scenario.
From the business, okay. Okay, at least what I've been hearing, I mean, I've looked at a few fintech players in this space, and what I'm hearing is there are two aspects of the documentation. One is the classification, so looking at the document and understanding whether it is a bill of lading or a certificate of origin or an invoice, and then actually extracting the data, so you're able to run your TBML related checks on the back of it. I think the classification or the identification of document is fairly high. High 90%, so 95, 96%. And then depending upon which fintech player you're looking at, I think the extraction of data is roughly between 80% to 90%. And then using machine learning, then obviously, as the models get trained, then that percentage starts growing up. Is that your experience as well?
So Ani, this is true for the traditional OCR-based models, right? Where you were dispassionately reading the document and trying to capture data from it. But what's happened now is, I spoke about contextualization. So now AI tools understand the context. So they're not trying to just blindly capture data from the document, but they understand that there's an underlying trade transaction. It should have these, 5 parameters. How are they linked together? So that has improved accuracy a lot.
Okay, interesting. We got about 4 minutes left, and there are 2 questions. So my easy job is to read the questions, and your difficult is to answer them. So the first one, BAFT is involved in TBML pilots in Europe that are being led by customs organizations. I think, Shri, you were mentioning about something interesting for the previous panel. Maybe you can take this. Where are countries in MENA on having customs taking a greater role? And I think this links back, I mean, we can expand the question to what you mentioned before, not just customs, but other ecosystem players, how everybody can work together.
Exactly. So I don't have an ideal answer to address this question, so I don't know. But what I know is even in the UAE, I believe the UAE customs also had sent some surveys to the bank to understand what data we have, what not, etc., etc. So something is happening, but probably not at a speed which ideally we expect, number one. How the emerging and technology which is evolving. More than that, who is using is not the financial institution, not these kind of private-public partnership, but the money launderers are ahead of us. They are using all those things at a speed where we are just lagging behind.
Yeah.
So definitely we will catch up, but it would definitely take time. That's my answer.
And I think along with customs, I think VAT, now with VAT getting introduced in the UAE, I think that provides another avenue for the organizations who use large amount of data, like the customs, but also the VAT authorities and then the banks, to work together to see how this whole information can be stitched together, either for better governance or simply for even revenue leakage for the country or for banks, right? Anything panel members want to add?
I would add to this. So yeah, I understand that maybe customers are not in direct touch with the banks on this. They provide a lot of data, the trade data that they issue on a monthly basis. And at the same time, they are in direct touch with the financial crime units. So they would be talking to each other. They would identify certain risks and certain mismatches that they see in the trades that they see. But maybe the regulator itself, the central bank, if coordinated between the financiers, the corporates, and at the same time the customs through the financial crime unit, then we can have better solution.
Sure. And maybe Todd, anything from a BAFT perspective, because it talked about BAFT playing a role in Europe about working with customs. Is there something that you want to add on, or we take it offline? Okay. Then the next question is on panel mentioned that the regulators shouldn't put the onus only on banks with respect to TBML, but isn't fragmentation and slow digitization within trade space limiting it?
I'll take this again. Okay, so I'm not mentioning that it has to be fragmented. That's the reason my last point was on PPP. So one is data sharing, integrating all those data across all these functions like financial institution, customs, freight forwarder, shipping company, like tax, whatever, revenue authorities, etc. So all those things, when it forms a proper ecosystem in terms of data sharing, etc. There are challenges in data sharing again. Cross-border data sharing is quite difficult, at least within a specific country. If that can be done, definitely we can. But currently what is happening is anything which comes out of central bank, it comes to the financial institution. Standalone, we are struggling. We are waving like this. No sound is coming. So some object, whether it is hand or whatever, has to come to ensure you get what you want. So that's what I'm mentioning. So it's not about fragmenting things like different people do different things, but integration is very key over here. And we need to use the emerging technologies, evolving technologies, etc. And one thing is very critical when you talk about AI or whatever it is data quality as well. So we need to ensure we have the data quality framework in each and every organization to ensure our data is free. Otherwise, if you run through it, garbage in, garbage out. This is the old terminology from a technology standpoint. That is what will happen when machine learning happens, when AI get implemented. If wrong data is fed, you get wrong output. You can't blame them. It is something which we need to ensure we address that at the right level.
Okay, we are about time, but just last 30 seconds, like closing statements from each one of you. Maybe I'll start with Shrew, please.
We need to be ahead. As I mentioned, criminals are ahead, right? So we need to be ahead of it. We need to ensure that we are on top of things rather than a reactive approach. Every one of us in the room, outside the room, whoever has not heard this as well has to have a proactive approach in terms of how to run this, risk control, and a good point which you asked, that growth as well, right? So it's not always about controlling the risk, which will eventually contribute to growth as well.
Okay, Ibrahim?
Yeah, throughout the discussion, I was thinking about blockchain when it came, and we started talking about having all stakeholders on board of the blockchain. And I think it's 10 years now, we still don't have this, and this would be a very good weapon for us in fighting the criminal activities related to trade.
I know we are out of time, but this one point. So I did not cover this in my answer, but a lot of work is actually happening on the blockchain side, not really with banks, but there are distributed ledger technologies which are helping create transparency and create immutable records so the transaction is genuine and trace the end-to-end supply chain. But maybe we could probably, that's for another time. I would summarize this as similar to what she said, that financial crime perpetrators are getting smart, but we can outsmart them using technology and through collaboration where all players work together.
Sure, look, and my last comments in a very unbiased view is trade is a very profitable business. So I think we should all be committed towards trade and know the risks. To manage the risk is I think the mantra. So thank you very much to the audience for your questions, and please join me in thanking the participants, the panel members.